slightly higher. Let's bring in David Stryzewski this morning. All right, David. I read your notes. Before I get to the actual, some of the stocks you like, you say, look, consider this about the Fed, and I found this fascinating. You said it takes 270 days, about 9 months on average, for rate hikes to hit the market. So with that in mind, you say we've only really seen 3% of the 5.25% that's been put in place. That is pretty sobering.
Yeah, that's right, Ashley. And, we've got a lot of negative indicators right now that are also very sobering, that are all flashing warning signs here today. Even like the Warren Buffett indicator that looks at the overall value of the market relative to GDP. Is indicating that we're, increased above about 43%. Schiller PE ratio up about 48%. We've got mean reversion that's up in the 40s. Inverted yield curves. We've got big challenges right now, and just like you said, maybe half or so of the Fed's implementation here has actually hit our economy right now, and flipping everything upside down, at least the way that we're looking at it.
That said, the analysts at Goldman Sachs are seeing lower signs of a recession than they originally expected. Do you see it that way?
Well, they cite the debt ceiling deal getting done, which is great. I don't know what we really got about it that improves our situation, in a real way. And then they're citing that GDP is not going to be that horrible. Well, whether we're going, positive 0.5 or 1% or minus 0.5%, I don't know that it feels very different for us, as things are absolutely slowing down. And then additionally, right now, we've got recessions in housing based upon volumes that are taking place right now. It's absolutely seeing a credit crunch right now. ISM indicators, which is manufacturing, one of the most accurate indicators of going into recession, is in a recession at this moment, and it's been there for a few months now. Consumer spending's coming down. We're just spending on experiences today, not buying all the normal things that we regularly do. Capital spending's going down from corporate side, so we're seeing an earnings compression today. That means slower growth for the future. Average hourly rates are growing at double what they used to be prior to COVID. So there's a lot of negative sentiment and things that are taking place. So Goldman's coming out with, a more positive outlook on things. I think they were probably wrong on 2008. I vote that they would be right, but, here's the reality. There's a lot of warning signs flashing right now, and I think we should be paying attention.
Yes. Another reality check this morning. David Stryzewski, thanks, David, as always, for sharing your thoughts with us.
Ashley.
Lauren, come back in here. Thank you. Looking at some of